I am not a professional financial advisor. The information shared on this channel is for educational and entertainment purposes only and should not be considered as financial advice. Always do your own research before committing any money to the stock market. Today we are diving into 3 undervalued defensive stocks to buy according to analysts that have the potential to make you rich. These are not random picks. These are stocks backed with solid fundamentals, strong brands, a clear growth plan, and the confidence of Wall Street analysts who see significant upside potential. So if you're serious about making money in the stock market, make sure to watch till the end and remember to subscribe and turn on notifications so you never miss an update on the hottest stocks in the market. First on our list is the Hain Celestial Group Incorporated, trading on NASDAQ under the ticker Hain. This is a prominent U.S.-based company specializing in natural and organic foods, as well as personal care products, a sector that continues to grow as consumers increasingly seek out healthier lifestyle options. Hain Celestial has built an impressive presence in over 75 countries, with a brand portfolio that includes household names like Terra Chips, Garden Veggie Snacks, Garden of Eden Snacks, Hartley's Jelly, and plant-based beverages under Joya and Atumi. The company sells through supermarkets, natural food stores, specialty distributors, mass market retailers, and club stores, giving it a wide range of customer touchpoints. The financials tell a mixed but interesting story. In the latest quarter, Hain Celestial reported a 7% year-over-year decline in organic net sales, driven by a 9% drop in North America and a 4% drop internationally. On the surface, that might sound discouraging, but the company generated $25 million in free cash flow compared to $15 million a year earlier, reduced its net debt by $12 million, and increased its adjusted EBITDA margin by 350 basis points from the first quarter. Adjusted EBITDA for the quarter came in at $38 million, while adjusted net income was $8 million or 8 cents per diluted share. Adjusted gross margin was 22.9%, down 60 basis points from last year, but SG&A expenses were reduced by 5% to $70 million, and interest costs fell 21% to $13 million, further strengthening profitability. The company ended the quarter with $56 million in cash and a net leverage ratio of 4.1 times. Its current stock price sits at $1.86, which for many investors represents a deep value entry point. Wall Street analysts see significant upside, with 4 covering analysts giving a 12-month average price target of $2.70 with a high of $5. That's a potential 52.54% gain from the recent price of $1.77. For value investors willing to be patient, this could be an attractive setup. Next on our list is Ambev SA, trading on the New York Stock Exchange under the ticker ABV. Ambev is a beverage giant with operations spanning Brazil, Central America, the Caribbean, and Canada. It produces, distributes, and sells beer, carbonated soft drinks, and other non-alcoholic beverages, giving it a wide range of revenue sources across multiple geographic markets. With a strong foothold in emerging markets and a portfolio of popular brands, Ambev benefits from both market dominance and consistent demand. In early August, Evercore ISI analyst Robert Ottenstein reaffirmed a buy rating on Ambev and maintained a price target of $4, signaling strong upside potential. From a financial perspective, Ambev's latest earnings showed EPS of 3 cents, meeting consensus estimates. However, revenue came in at $3.59 billion, falling short of expectations of $21.84 billion, a miss that caught investor attention. Despite the revenue miss, Ambev remains a stable income-generating stock thanks to its established market positions and attractive dividend yield. The stock is currently priced at $2.21, well below the average analyst's 12-month target of $2.88. Among 6 covering analysts, the highest price target is $4 and the lowest is $2.50, with the average representing a 28.57% upside from the most recent price of $2.24. For investors looking for a low-price stock with consistent dividend payouts, international exposure, and the backing of strong brands, Ambev continues to look like a solid defensive choice. Its market reach and ability to adapt product offerings to changing consumer preferences give it resilience, while its current price offers room for appreciation if operational performance strengthens. Last on our list is Nomad Foods Limited, trading on the NYSE under the ticker NOMD. Nomad is Europe's largest frozen food company, selling under iconic brands like Bird's Eye, Iglo, Findus, Lido, and Frickum. The company's product lineup includes pizza, poultry, fish, vegetables, and ice cream, and it operates in over 16 European countries. Frozen foods are a defensive staple because consumers tend to keep buying them regardless of economic conditions. But even defensive sectors can face short-term pressures. On August 8th, Barclays lowered its price target for Nomad from $20 to $18 while keeping an overweight rating, noting that the company had once again cut its 2025 guidance due to historically hot weather in Europe, which weighed on frozen food demand. In the latest quarter, revenue declined 0.8% to €747 million, with organic revenue down 1.1% due to a 1% drop in volume and a 0.1% decline in price/mix. Adjusted gross profit fell 10.8% to €208 million, with adjusted gross margin contracting by 310 basis points to 27.8%, primarily due to supply chain inflation. Adjusted operating expenses decreased 11.4% to €103 million thanks to significant cost-cutting measures, and advertising and promotion spending declined slightly year-over-year but rose 5% through the first half of the year, indicating continued brand investment. Adjusted EBITDA fell 7.2% to €129 million, while adjusted profit dropped 16% to €61 million. Adjusted EPS fell by 4 cents to 40 cents, and diluted EPS decreased by 6 cents to 37 cents. The stock is currently priced at $15.40, with analysts giving an average 12-month price target of $20, a high forecast of $25, and a low of $16. That average target represents a 31.41% upside from the last price of $15.22. For investors seeking stability, international exposure, and the potential for moderate growth, Nomad offers a defensive position in a sector where consumer demand remains steady even during economic uncertainty. Well, that concludes our list of 3 undervalued defensive stocks to buy according to analysts that could offer big upside in the months ahead. The Hain Celestial Group, Ambev SA, and Nomad Foods each bring something unique to the table, whether it's strong brand portfolios, consistent demand in essential goods, or exposure to growing international markets. They may be undervalued today, but with the right market conditions and continued execution on their business strategies, these companies have the potential to reward patient investors handsomely. As always, remember that investing comes with risks, so do your own research and consider your investment goals before making any moves in the market.